Freya?
Yeah, I think one of the ways I like to look at this is to look at how much money people have in their bank accounts compared with GDP, and that is a very cyclical indicator. And that by the end of last year was starting to look quite toppish across every single different income segment. So the middle income segment is one of the most important in the cycle. They're one of the most cyclical parts of the economy, and it was starting to look as though on an individual basis, people might not want to be trying to spend down their bank account. So this is a legacy of the stimulus that happened over the pandemic. Some people call it excess savings. I don't really like to use it in that term, but the amount of money basically that was still in people's bank accounts in excess of what they were used to having. That that tailwind has very much sort of worn out. So that means growth is probably going to be at trend, and then you've got a negative shock, right? So in that context, you would probably want to be cutting rates. The problem is that the negative shock is a negative supply shock, which is pushing up inflation.
Yeah.
And at the moment, we've just been through a period of time in which we've had some negative supply shocks and some positive demand shocks that have caused, as we all know, a lot of inflation, right? So if you have another shock that creates inflation, pushes inflation up at this stage in the game, then central bankers are going to look at that and say, okay, well, we need to just be a little bit circumspect here, and think about the wider context in which you've got negative supply shocks as a result of tariffs, but perhaps more importantly, from the perspective of the Fed, also negative supply shocks from the perspective of the labor market, which hasn't even really begun to figure in terms of the data coming through or the way that the people are thinking about things, because we're just focusing on the tariff shock at this stage in the game.